Did you know that the return of Nvidia stocks was 0% or at least close to it for the first 15 years of it being on an exchange? Whereas the past 5 years, the profit has been close to 3,000%. With that crazy quote, welcome to all listeners here for the Saxo Market Call podcast. As always, I am your host. My name is Søren Otto, and I have a great show lined up for you today. We're going to talk about news and market updates, focusing a little bit on Jackson Hole from last week. Then we're going to dive into Nvidia, which I just teased for, and then we're going to talk a little bit about the U.S. election after the Democratic National Convention. And before I introduce the two guests that I have lined up today, have you guys ever seen any other company develop in a similar fashion as Nvidia? John, Peter?
I think we were having a little conversation about this earlier, and I was talking about some wild performance swings from greatness to to near death, and then back to greatness. Akamai, look it up. It was a very fascinating story from the pre-internet bubble days to now. But I think I think it's the speed of ascent to this level of market cap. So what were we talking about? The world's largest company. It has been at a couple of times in recent months. So Peter, $3.5 trillion at one point or close to that. Maybe only Tesla has, it didn't get quite that big, but has seen that kind of ramp, at least the speed of that ramp. But, this is a remarkable company, and that size is what's, I guess, the scale and speed at which it got to that size is what's really amazing, isn't it?
Yeah, I think Tesla is actually a very good example. I think it speaks into, the what's it called, disruptive technologies suddenly coming about, where you have a company that been around but is uniquely positioned to take advantage of that disruption, and that what causes those very big eruptions or ascending share prices, like you mentioned with Tesla and Nvidia. But no, Søren, very quickly, I don't think I can recall something like this before, because typically the biggest and the best companies in the world that we see today, they have typically been on a very long journey for maybe 10, 20, 25 years, where they very early on in their business found a moat, they found a technology, they found a business model that really was just profitable and also could generate high growth rates, and that's what makes Nvidia quite unusual. But I actually talk about it a little bit. I write from time to time these quality pieces. The first one I did was actually on Nvidia, and I actually highlighted this fact, and I think it's one of the reasons why so many of the great investors actually missed Nvidia, because as I also write in my piece, it was this hidden gem. I mean, on a lot of metrics, it was not a very interesting company. The only signal in all the noise was actually that you had a company that was plowing in massive amounts of money in R&D for years. And I think that's also the reason why you had that very flat, because he was just reinvesting so much of the profits that they generated into R&D, and that that because it flows over the income statement, it compresses sort of your earnings statements while you're just heavily investing in the future. And
they had the leading technology in graphics cards, and it got to be where you would spend as much on your graphics card as the rest of your computer. And then it turns out those graphics cards, the GPUs, so the processing units, 4 of those could be used for crypto mining.
Yeah.
Scored a random, bit of luck there, I would say, for the company. I don't necessarily think that was their strategic aim. And then just follow on to that, the massive from crypto straight into AI, where these same processors and the newest generation of them being used for the artificial intelligence.
And we are going to talk a lot more about Nvidia. And with that, I think we had a pretty nice auditive introduction of not just Nvidia, but also my two guests to my right. I have John Hardy back, our new, not new, but with the new title.
Very not new.
of lead macro strategist. Is that correct, John?
Chief macro strategist.
Chief macro strategist.
Still trying to figure it out what I'm called, yeah.
And then further to my right, we have Peter Garnry, chief investment strategist. Also hope I got that one right. And just to elaborate a little bit on what Peter said, you do these quality pieces, and not only is the piece of very high quality as always, as everything you do here, Peter, but it's also focusing on quality companies, which is sort of the hook, and you attempt to get them out weekly. And as with everything else both of you gentlemen do, I can only recommend that you read it on our website or on our platform. All right, let's move into the first area that we're going to talk about today, which is news and market updates. And I think the past week, I mean, it seems like everybody has more or less just been waiting on Nvidia, but we had this big event in the US central bank, which is called Jackson Hole, which is basically just geographical position of where all of the central bankers are meeting. That took place last week. And Peter, I think it was last time, or otherwise it was just a discussion we had. You said sometimes it matters, sometimes it don't. What about this time? Did anything come out of it that matters?
It was not really any shocking event, to say the least. I think the takeaway is that Powell basically gave the green light for the Fed to initiate its descent from these very high policy rates. So that's really... So now the guessing game starts. What is the descent speed? Where are we going? Where is the floor? Where is the neutral rate? Can they, and that would be, I think, maybe the first or maybe the second time where the Fed is able to slowly take down the policy rate without that rate cuts being a signal that we are moving into recession. So in other ways that they can actually create a smooth transition into a stable economic background. And I think, and before you talk, John, I think this is where it gets interesting, because there will be an intersection now between the Fed's rate cut cycle and the US election that is coming up, where the outcome potentially is very, very, very impactful for markets. Although you will never get Powell to say that it has any impact and he's not reading into politics, you can be absolutely sure that the central bank is well aware of that given outcomes at the US election can mean different trajectories for where the policy rate is going to be over the next 12, 18 months.
Yeah, maybe they have a political choice they'd like to see. That's all conspiracy theory, but I'm quite strongly convinced that they would definitely not like to see Trump in the White House. Yeah, so there are a couple things on Jackson Hole. Yes, it's just confirming what the market expectations are. We all know that a rate cutting cycle is about to kick off. There's still, and even after the speech, there's still the question 25 or 50.
Which is the basis points.
Yeah, basis points. So 0.25 or a 0.5% interest rate cut at the September 18th FOMC. And there was even some language that I think some saw as a little bit dovish that he opened up in his statement that there's that the timing and pace, quote unquote, of the cuts will determine on incoming data. So the incoming data releases are going to be very much a trader event. So if you put your trader's hat on, look at this Friday's PCE inflation data point for July. Very much look at, even though we see the employment report is coming up next Friday, September 6th, you see that traders will react to it, and they'll react to payrolls changes numbers, even though we just got the annual revision in. And it was, just a little 800,000 off, no big deal. So it just shows you that month to month is a completely worthless data point, and yet we all trade it nonetheless. What has been more right, apparently, relative to those revisions is the so-called household survey, which is showing this creeping unemployment rate higher. Some have invoked the so-called SAM rules, or same rule that says that once it's gone the X percent above the base, that means we're already in a recession, et cetera, et cetera. And let's look back. It's a small sample size, but just about every time the Fed has started a rate cutting cycle, it's not something to be celebrated. It's something to be feared, because it means the Fed, as always, is behind the curve and will be playing catch up to get ahead of whatever this recession risk is. And that's the big question. Is this a soft landing, or is this something of a more nefarious variety, a harder landing? So, yeah, very interested in the trading events around these incoming data. Last one being the September 11th CPI release for August.
I mean, it seems like to me that especially after the financial crisis of 2008 and going forward, a lot of central banks' move have been about perception. How does the markets perceive what is going on? As you say, is it a recession or is it a soft landing we're going into? And I guess that's very precarious to handle for them right now, especially seen in the light of the U.S. election, and at least on the surface, the fact that they don't want to push against either the Democrats or the Republicans.
They don't want to be seen as doing so, and therefore they're going to have to point to incoming data. So if that incoming data is mixed, doesn't look like anything, they'll have to go for the 25 basis point cut, even if they're actually quite worried about where this economy is headed and would prefer to go 50. I think there maybe is a little bit of this political sensitivity in play. But by the same token, if the incoming data is weak enough on the inflation and jobs report front, they can point to that and say, yeah, we had to go 50.
All right, and obviously that's what's been happening primarily in the past week or so. Looking forward, obviously we are recording this on Tuesday, and Wednesday is where we have the big Nvidia earnings, and I think that's more or less what everybody's holding their breath for. Is there anything else that's worth mentioning for the coming week? Any other figures coming out? Anything else?
You're too fast. Because your initial question was actually what had in the market, and we just jumped into Jackson Hole and went on a spiel there. But if you just for the overview, it was an interesting week we've just been through, right? Because we had a complete reversal that all the strongest momentum markets this year or sectors have been the worst performers in the past week. So your information technology actually down 1.2% over the past week. Communication services, where you have Google, Meta, Netflix, etc., only up 0.2%. The two winning sectors has actually been real estate, exactly because of all the reasons we just talked about with Jackson Hole, and then materials, because we have a pretty significant rebound now in spot prices across a lot of commodities. Interestingly enough, the energy sector is only up 0.3%, which is a little bit odd given, the backdrop of all the geopolitical risk and potential more war-like scenarios flaring up in the Middle East. So that's a little bit of an outlier there, but you have metal prices going up, and that has had a positive impact on the materials, which is basically chemical and mining companies. It's the mining companies that have generated these results. And because of the sector composition in the world and the returns we have seen, the US has actually been a low performer, only up 0.2%, whereas Japan and Europe has been the best performing markets.
I just to break in there, so it's really good breakdowns there, far above my pay grade in terms of the in terms of the quality of the breakdown, but just very anecdotal as more of a trader's hat on. I recall that I saw the one day this week, I don't remember which day it was, very recently, the Russell, or if it was this week or last week, apologies, the Russell 2000 exploded higher on a relatively uneventful day for the broader index. I remember this odd jump in the Russell happened as well, just before all the craziness we had starting later in July. I wonder if there's some kind of weird rotation going on internally in the market focus, and part of this whole unwinding, or to a degree at least, in this so-called dispersion trade that we covered some weeks back. So the idea that you would sort of short general broad market volatility and go long the volatility in the individual stocks. And if that is the case, if we are seeing some further, rumblings in the tectonics of this so-called dispersion trade, that means we should actually double down on our focus on tomorrow's Nvidia earning results, because that is being very highly bid up in terms of volatility. 117% implied volatility for the Friday expiry options. For those of you not familiar with that measure, it's crazy. So for a stock trading $126 and change, if you want the right to buy Nvidia at $140 this Friday, it'll cost you $2.50. So the stock will need to move well over 10% to even break even on that trade. There's 69,000 contracts at that call price. You can see that calls are bid relative to puts. People are looking back at the past of these earnings releases and seeing that back in May, it moved about 10% on the day after the earnings announcement, more than 16% back in February, but then only around 2.5% in November. And if we go back to last August, I remember there was incredible anticipation around that earnings release, and the price was exactly unchanged, almost to the penny, the day after earnings, which meant that every single punter in options directionality got crushed, and it was the option sellers the one. So any range of outcomes is possible. I guess the most important thing would be what is the actual news, and we can drill into that if we have time.
Yeah, and we will go into Nvidia in a second, and obviously I hope people followed it. There was a lot of numbers, but
sorry.
I mean, you're always good at explaining it, John. Hope people followed it there for sure. But just back to my question. Thank you, Peter, for outlining pretty good and remembering what we have to go through in this podcast. Is there anything apart from Nvidia in the next week that you really need to pay attention to as an investor or market interested person?
Well, we have seen the market reacting a little bit to these initial jobless claims. It's the most timely weekly series we have on the labor market. The initial jobless claims the past 2 weeks have signaled not a deterioration of the labor market to the extent that potentially was communicated from a lot of the Fed speakers. So I think that remains it remains one of the key indicators to watch, and that's on Thursday. Outside the Nvidia earnings, just to highlight, we have Salesforce, pretty big company, also reporting the same day, around the same time, but it will obviously be in the shadows of Nvidia. Everyone will be talking about Nvidia. And then CrowdStrike, which is and was one of the world's most valuable cybersecurity companies at one time, until they had their big faulty update to their systems on the 19th of July, and they created a huge cybersecurity disruption around the world. There will be a U.S. congressional hearing around what happened. There is a key meeting on the 10th of September with Microsoft to avoid and to get to the root causes of what happened. And a lot of both the congressional hearing, but also the meeting from Microsoft, will set the stage for potential litigations from customers against CrowdStrike. And I think this is the ultimate tail risk of the cybersecurity companies. Some of the numbers out there are suggesting that they will be reporting a 50% drop in new annualized recurring revenue, the so-called ARR metric, which is the most important one for a SaaS company, and especially also these cybersecurity companies that have created these platforms. So it is potentially a new recalibration of the whole cybersecurity. And we got a little bit of a glimpse from Palo Alto, which is the most valuable and the highest revenue-generating cybersecurity company in the world, that they have seen an uptick in inbound orders because of what happened to CrowdStrike. So a lesson here potentially is that maybe for most people, instead of going with what you think is the long-term winner, maybe trade the theme. Find an ETF that gives you a broad exposure to the cybersecurity, because the cybersecurity industry, and that's also why there is a congressional hearing, it's confirming exactly what we have been talking about for years with our clients. This is a systemically important technology for the digital infrastructure of a country and a corporate sector. And that is also why it's a super interesting theme, because even when we get to the next downturn, the recession, it will prove that cybersecurity companies are insulated from spending cuts, because you cannot cut something that is essential to how you run your business.
Definitely, and a lot of good points there, and a lot of interesting companies to actually follow this week. Let's do our best to try and cover them next week when they have reported. But for now, let's move into talk about Nvidia. Because Nvidia has grown to become one of the most, at least attention-grabbing companies for over the last few years. It has a big role to play in AI. It has a role to play in cryptocurrencies, or at least the mining of crypto. And it's just performed pretty incredibly. And as I said in the beginning, early days when it was more graphics-oriented for CPUs, the performance was lesser than it has been over the past at least 5 years. But Nvidia, super interesting company right now. I guess also super important for sort of the trajectory of AI, which is increasingly questioned, at least over the short term. Peter, what are your expectations for this Nvidia earnings report?
Well, that it's going to drive every headline. It's the most key story out there in the equity market, because of all the investments that are going into GPUs for AI training and inference of existing applications. It's a significant part of the overall earnings in the S&P 500. I saw Bloomberg was floating a number somewhere between 6 and 7% of earnings in the S&P 500. It's a significant earnings release that are coming. It is the one to watch. And what do I expect? Well, I think that Nvidia, I'm committing now on this podcast. I think I and I can obviously
listen
be wrong.
closely out there.
Yeah, I can be wrong. I think Nvidia will beat consensus estimates for the quarter they just left. And I think also Nvidia will surprise to the upside against the expectations for the current fiscal quarter they're in, which will end in October. But if I'm wrong and they miss the slightest, we just saw with PDD, the parent company of Timo, that these very high explosive, high growth companies with high valuations, they're super sensitive to a revenue miss. So if I'm wrong and they miss on the revenue, that will be a little bit of a mayhem, also because of all the options shenanigans, or not shenanigans, but a lot of the options plays that are being played, as John mentioned. So, and then my final point is that in Nvidia, they postponed this Grace Blackwell 200 chip because of a design flaw. And they pushed it to the first quarter of 2025. If they come out and say they have to delay it further, that these design flaws were not temporary, but actually they're more systemic, then I think we're also in for a hiccup.
That's a dangerous one.
Yeah,
because what's being touted, I mean, I think that, you look at a company like this, and its pricing is based on tremendous growth at 40 times sales. I can't believe I'm saying that. Tremendously profitable company at 40 times sales. So it's super dependent on not just the next quarter or two, but some kind of roadmap to something next. And this is the next great thing, this Blackwell chip. If it's true what the company touts, that it's sort of energy efficiency and doing calculations could be as much as 25 times better than the previous generation. And you mentioned something that I hadn't even read as deeply as you, that its methods for coming to certain conclusions in these AI calculations is far more efficient. So it's not just about the power saver, it's actually more efficient, even though it's like somehow its raw horsepower level is only maybe a couple times greater. But all in all, this is something people would like to have now if they could have it now. And of course, something that's so much better and so much more energy saving could even mean that people have to reinvest just to start saving money on energy costs, even if there's, as a component of the future growth for the company. So, then there's this air pocket risk. Some have touted that, maybe people hold off the purchase of further current generations that are waiting for this Blackwell chip generation. I don't know.
And that's the risk.
It could go either way for sure.
That's the risk if they delay that you have this air pocket, because why would you continue to invest in when you have this great chip? I mean, just for the listeners out there, so there are two aspects when you use the GPUs. There is the training of the large language model itself. It's more compute intensive, and you go back and forth. You need to recalibrate this massive neural network. It takes a lot of computation, a lot of energy. As soon as you have your large language model, then what comes next when you have it in the application, when we are all sitting in ChatGPT or Perplexity or Gemini from Google, we type in a certain question, and then it takes a sequence of all these words you have typed in. It has to run through the large language model. It's called an inference, and then it gets a result back. So this is the sequence of words that best statistically is matched to what you inputted. And that inference is going to be 30 times more efficient with the new Grace Blackwell. And that is potentially, and I think that's the bet, that it will massively improve the inference, and it will improve the speed, so the commercial applications will feel better and respond faster. And that potentially, and they will all bet on this, Microsoft, Meta, Apple, Amazon, that is what pushes AI through the wall on the commercial adoption, because we have a problem in AI. The investments right now are vastly surpassing what is sustainable unless we can see concretely that we can
earn money.
We need to generate more revenue. As I said a couple of times, it's estimated in the VC industry that we're generating somewhere close to $100 billion from AI-related services. With the current run rate that Nvidia will reach by the end of this year, we need to generate $600 billion of revenue. So we need to get going on commercial applications like Copilot in Microsoft Suite, etc. I mean, we're using that now in Saxo, right?
And on that note, there's that composition problem. I think we touched on it before. The composition problem, meaning that's a lot of spending. Nvidia, yay, hooray!
Yeah.
But where are these profits coming from? It's coming from a very large investment from, in many cases, some of these very, very deep-pocketed companies that has to be hitting their bottom line. You would think at some point, unless they're seeing their again, the end applications increasing. So the Googles, Amazons, Microsofts of the world, what are their spending budgets looking like on the power side and as well as on the actual equipment side for this?
Exactly.
And so it seems like not just for Nvidia something hinges on this report, and at least the development, especially with this new chip. It's also related to the broader AI sector, really, that it could mean. Not necessarily whether it's going to die or stay alive, because it's definitely going to stay alive for sure, but it could have some impact, at least on the shorter term or medium term.
Absolutely, and also for the economy. If you look at CapEx spending in the US economy and manufacturing spending, there is no other category than semiconductor manufacturing capacity that is growing like that in the US at all. So it's the whole national security aspects in the U.S. with the Inflation Reduction Act and all these different policies that Biden have implemented, you've seen this massive ramp up in semiconductor manufacturing, and it's an economic miracle for a lot of rural U.S. because a lot of these data centers, a lot of these semiconductor manufacturing plants are not built in big cities. So it's actually real jobs, it's real growth. out there in the US, in the rural area, and so I think there are real things at stake as well if this AI can continue.
All right, let's now move into the final part of this podcast. I know we have a lot to talk about as always, but we also have, I know especially you, John, have other things you need to attend to shortly. And I really want to get you, as you're kind of our US election expert and now also chief macro strategist, so that kind of makes sense. But just to sort of establish a bridge between this AI, do you see any way that Nvidia or this general, whether AI is going up or has a slightly more negative view to it, does that have any effect at all on US election or the way that the two candidates will campaign?
You're throwing me a tough one there. That's a very interesting question. I'm not sure where to address it. There's a couple things I would relate AI to on that front, and that is that a lot of content out there, they're talking about there's a lot of just garbage content out there. I mean, you can get an AI to set up, you can set up a theoretical publication that looks reasonable and get AI to produce a bunch of articles, and those could be passed around and shared. So it's the old misinformation. Is it nefarious actors, or is it just people trying to get ad revenue, or is there a difference between those? Whatever. So it's potentially creating a worse noise space. It could tilt the election one way or the other. That means political danger for the space and regulation, and how does AI work? There's that side of it. And then there's the whole geopolitical side of AI and access to these NVIDIA chips. There was a recent article exclusive from Reuters where they pointed out that while China was, with or without the attempts to ban these chips from making it to China, that actually the Chinese military and many outfits in China were just simply accessing Amazon Web Services and other data centers that are using, just accessing it over the cloud, basically. It's a very difficult and thorny issue for I think the U.S. and from many angles, really.
All right, and moving away from AI, if we just look at sort of the news stream from the U.S. election, we had the Democratic National Convention concluding last week as well. Did anything come out of that surprised you, or anything election related that's worth mentioning from a financial angle?
Yeah, I think, there's a couple things. Democrats are really riding high on a wave of just vibe, and what many were making fun of, the fact that this word joy was constantly used during the convention. But, when you get down to the brass tacks of the actual election itself, is this going to be enough to carry them into November? Maybe Trump is flailing badly enough to, and can't find a groove that this can continue. But we need to see an off-the-cuff interview, an impromptu interview with Harris. Will this debate happen? Now that's suddenly in doubt. So there are a lot of questions I have. It looks very evenly split. I don't think this Robert F. Kennedy endorsing Trump and going away will have any impact. I mean, he already lost 2/3 of his votes in the polls, and that didn't really do anything but maybe gave the Democrats a slight boost, mostly because Biden bowed out. So lots of questions, no answers at this point. And it feels like the market is really not in focus or focusing much on the election right here just yet.
No, I mean, we're also, now we have the conventions over, and we most likely at least have the two candidates that are going to run for president. We have to assume that at least. So now I guess we're just going into campaigning mode, and now we have to start watching the polls and obviously the debate if it's happening.
Yeah, and they've edged slightly more in favor of Harris, but she has to have quite a strong popular vote margin, and we've grown with good reason to distrust the polls after the last two election cycles, and it'll be all about turnout, not just the polls. Who actually shows up or sends in their ballot and actually shows up on election day. That's what this election will be about.
All right. And Peter, do you agree from a market standpoint that there isn't really any material impact?
What do you mean by material impact from the election?
From the election. Maybe focus, you mean?
Yeah.
Focus at this point.
Well, I think that what I find interesting is that I think the market is completely underestimating what's at stake if you get a sweep, whether it's a sweep in Trump's direction or a sweep in the Harris direction. Because as I've said repeatedly, we live in an era of populism, both in Europe and the US. And I see a strong Harris government and a strong Trump government being inflationary to the US economy. None of those two candidates are going to trade short-term political gains for sound long-term economic policies, and that is the danger. So I think actually, if we talk about inflation, then the best scenario is actually a Harris where you get a split Congress where she can't do what she wants, and some policies will just peter out, and that will slowly take inflation back down. But with the risk, of course, that then you get some type of recession. So I think those are also the three scenarios that we have talked about, John, and we'll be writing about, and we'll put out on our election page very shortly, which you can see inside our trading platform.
Yeah, I just wanted to correct one mistake from the last time we talked politics on here about the Senate composition. I was one vote on the wrong side of what I was saying. Yeah. I thought
sure, a lot of listeners noted that.
The key thing here is this: Democrats have 51 votes now. They're going to lose one of those votes automatically. Manchin is not running. He was always a wobbly candidate for the Democrats anyway, or voter for the Democrats anyway. And there's a very popular governor in West Virginia who's running, and he will get that seat. So that takes us to 50-50. There are far more Democrats that are being twice as many Democrats almost than Republicans that have Senate elections this year, which means they need to win all of them to maintain that 50-50. There's one, especially in Montana. So it could be, we talk about the impact of these scenarios, Peter. So the irony could be that, let's say Harris wins the House and she wins the popular vote by a certain margin, and then it's one Montana Senate seat, one Senate seat in Montana that entirely derails and prevents her agenda outside of the usual foreign policy and executive action. So the Senate is where the drama is. Far easier for Trump, because if the election is tilting towards him, he's already got a favorable Senate election map anyway. And again, if the Senate is 50-50 on election day, it's whoever wins the presidency that gets that vote, because the vice president, in the cases of ties in the Senate, can cast the deciding vote.
All right. So, a lot of election talk, obviously. It's definitely going to grow in importance for markets in the next couple of months now. John is leaving. Thank you so much, John, for your input. You have other things to tend to. Obviously, Nvidia is...
So now we can get serious, right?
Yes, now we're going to do the cool stuff.
All right.
No, I am actually just trying to summarize. And interest rate cuts seem like they're going to happen from the Fed based on Jackson Hole. Nvidia is what everyone is eyeing. But as you mentioned, Peter, there's also other companies that are worth paying attention to in the coming week. Election a little bit further out, but will also be interesting. Do you have any final thoughts or anything you want to leave the listeners with before we say goodbye?
No, I think actually we covered a lot of things. It's just the only leaving remark I would put out there is just that it feels like we're headed into a very important inflection point. I think that, and I haven't fleshed out my exact thoughts yet, but I see what's going to happen now as an interesting intersection between monetary policy trajectory and the U.S. election shaping the fiscal policies. It's almost like, you have this intersection and you have these two cars coming towards this intersection with full speed, and is it a collision? Will they not hit each other? What will happen? But that's sort of the image that is in front of me when we talk about all of these things. It's an intersection and can either end very badly in a collision, or we can avoid the worst and then and we can go on.
Definitely feels like things will be different once we hit 2025, but that's also what we're trying to cover here. And we will be here every week together with you. Thank you, Peter, for making us all a little bit smarter again today.
Thank you so much.
And to all of you listeners out there, thank you so much for tuning in to another episode of the Saxo Market Call podcast. On behalf of Peter Garnry, John Hardy, everybody here at the Saxo Market Call, and everybody here at Saxo, of course, my name is Søren Otto. Thank you so much for listening. As always, we really encourage you to come with your feedback if you have any, and just send it to marketcall@saxobank.com, especially with this new setup that we're introducing. Apart from that, I have nothing more to say than we will be back next week. And until that, happy investing.